Hey everyone, this is Green Spud Trades, and in today's episode, I'm going to be taking another look at the U.S. Treasury yield curve inversion of 2019. I have data going back to the 1960s, and I'm going to analyze in a historical context what does a U.S. Treasury yield curve inversion mean? Is it a surefire indicator of a recession, and what does it mean for stocks? So for this analysis, I'm using a tool called USTreasuryYieldCurve.com. And on this website, there's a feature that lets you examine what the interest rates were at a given period of time in history. And right now, we're looking at a chart where the red line denotes what the yield is on the 3-month Treasury bills, and the gold line indicates what the yield is on the 10-year Treasury. So, like if you look here at this spot, in 1964, you had a 3-month Treasury yield of 3.86% and a 10-year yield of 4.19%. So the 10-year yield was above the 3-month yield, as would be in a normal upward sloping yield curve. And as you can see here, you have that 3-month and you have the 10-year. And the normal yield curve during a normal expansion time is upward sloping, with the longer dated treasuries offering more yield, more return on your investment than the shorter term. So when you have a case where the gold line goes below the red line, that's a good indication of a yield curve inversion. So let's look at this case, what it looked like when the 10-year yield in October of 1966 dipped below the 3-month yield. And here we have a downward sloping yield curve. And this is what has historically been considered an indicator of a recession about to come. So another thing that we're going to be looking at is the S&P 500 price. So this green line here denotes what the S&P 500 value is, and the axis for that is here on the right. And as you can see, back in the 1960s, the S&P 500 was only in the 100-point range, whereas today we're at 3,000 points. So the S&P 500's grown and expanded quite a bit since then. Now, there's actually a couple reasons that we're only going back to the 1960s to do this analysis, and that's because we don't have good data going back further than that. The Federal Reserve doesn't have any published numbers that allow us to build a very good yield curve, and the S&P 500 we don't have visibility into back before the 1950s. Now, another thing to look at on this chart is the gray bars, which indicate a recessionary period. And I got this information from the Federal Reserve as well. So if the yield curve inversion is actually a good sign of an impending recession, every time we have an inversion where this gold line goes below the red line, we should have a recession soon after. Now, the first one to note here on this chart is this little dip right here. And it actually was very brief. I showed you what the picture of that one is. And it didn't really amount to anything. There was no economic contraction in any short period of time. You had 1966. We didn't have a recession until 1969. However, if you look here around 1969, that's when it started to invert again. And then the economy went into a recession. Now, another interesting thing to note about this red line is the 3-month Treasury is pretty close. It usually trades pretty close to what the 1-month Treasury is, and the 1-month Treasury usually goes pretty close to what the federal funds rate is, which is set by the Federal Reserve. So what this would indicate here, where you have this steeply rising 3-month Treasury yield, means that the Federal Reserve is actually pretty much setting this, and it's causing the interest rates to go up from the low 4% or even the 3% all the way up to almost 8% in a period of about 2 years. So it kind of makes sense that if the Federal Reserve is raising the short-term side of the interest rate yield curve, if the 10-year yield doesn't budge as much, then at some point they're going to raise so much that the 3-month yield curve goes above the 10 because the Fed keeps raising the interest rates, and then the 10-year yield is a bit more stable and doesn't react as quickly. So we have this really steep incline here. So one of the things that we could probably surmise or extrapolate from this is maybe the recession was caused because the Federal Reserve kept raising interest rates. Now, this chart doesn't have inflation, so they're supposedly raising the interest rates to combat inflation, but it does make sense that if they raise interest rates in an attempt to cool off the economy, it will cause an economic contraction, and that's exactly what we see here. So I don't know, maybe the yield curve inversion is more of a factor of just the short-term interest rates going higher and the 10-year being more stable. That's probably one way to look at it. Let's take a closer look at this chart in context according to what the yield curve looked like at different time periods. So on this chart, the gold line represents the interest rate curve in 1965, and then in 1966 we had a slight inversion, and then in 1968 it was pretty flat. Let's try to see what it looked like in the middle of 1970. And as you can see here, the interest rate curve started to look kind of normal again. Here you can see on this chart the 3-month yield collapsed, and the 10-year yield actually started moving higher. And then we went back to a normal growing economy for a few years. So to help us get a better perspective on these yield curve shifts and the recessions that follow them, I put together this little spreadsheet so that we could track them. So in this column we have the yield curve inversion, how long it lasted and how big it was. A recession, if a recession followed, what the dates of that recession were, and what was the impact on the S&P 500. So on these first two dips of the yield curve, there was no immediate recession that occurred. The 1966 and 67 one, the yield curve may have inverted in anticipation of a recession because the Vietnam War was starting up, and it may have been induced by fear and concern, but one did not really occur until a couple of years later. So that's an example right there of how you could have a yield curve inversion, and it doesn't necessarily mean that you're going to have a recession. There was a stock market crash, though, a correction of 24%, so corrections happen from time to time. But it doesn't mean that there's going to be an economic contraction. When there's a correction, the market usually just continues heading higher once things rebound. So the next recession that I want to take a look at, or yield curve inversion that I want to take a look at, is this one that occurred in the early 1970s, where you had short-term interest rates rising very rapidly again, and then they rose above what the 10-year yield was, and you get a yield curve inversion. And this one actually correlated with a pretty nasty stock market crash. In my chart here, the stock market actually had as much of a 50% correction. It was a fairly rough time economically. There was a lot of unemployment. and the price of oil spiked during that period of time due to instability in the Middle East. And this energy crisis caused a stagflation sort of situation where prices were going higher because of the price of oil, the price of gasoline, and the economy wasn't really growing. So this is a case where your yield curve inversion was very pronounced, and it was an accurate predictor of a recession and stock market crash. So here's what the yield curve looked like when the economy was expanding during that period before there were recessionary troubles. Here's what it looked like near the beginning of the yield curve inversion. And here's the yield curve in the middle of that recession. And lastly, what the yield curve looked like when things returned back to normal in the markets. So now let's take a look at these charts in the later 70s and in the 1980s. The late 70s also had quite a bit of economic trouble. And as you can see here, the red goes right above the gold line, so interest rates are rising again. And just before going into the 1980 recession, or the 1979 recession, this happens. And then it gets more extreme as you're going into the recession. And then the interest rate curve seems to normalize a bit towards the end of that recession. And then the economy dips again. And then you have another yield curve inversion predicting the 1981 recession. So one of the things to consider when looking at these figures is that a recession could actually be going on, but it hasn't been officially declared yet. And then when the numbers come out and they revise the GDP growth numbers, then the recession dates actually get revised. So it could have been at this time here in the later half of 1979, the economy was already in a recession, but the Fed didn't really declare it until they historically revised the numbers. So, that people may not have known the recession was going on officially yet in this early part of it, but the interest rate inversion would have told you that something was going on if you believe in the interest rate inversion theory. Here's a look at the numbers associated with this recession. In the 1978 to 1981, the unemployment rate went up, but you didn't get a really big correction in the stock market. However, when the 1981 recession rolled around, you did get a major correction, with the stock market bottoming out in 1982, which was a 26% pullback from its peak. Okay, so let's take a look at the later half of the 80s and the 1990s. So the economy, once it got going in the 1980s, things were pretty good for a few years. And then you had the 1990 recession, which happened around the time of the Gulf War in Iraq, the first one. And what's interesting about this recession is that you didn't really get that 3-month yield curve going above the 10-year. However, you did have a recession occur, so you didn't get the indicator, but you got the recession, and you got a little bit of a stock market crash during that time period. Once again, the Fed also steeply raised the interest rates during this time period. As you can see here from 1988 going into 1989, the 3-month B lines from below 6% all the way up to almost 9%. Here's a look at what the yield curve did at different points of time. So in 1989, just before the recession, the interest rate curve flattened out. As you can see here in 1986, it was upward sloping and normal. Interest rates across the board went higher, including the 10-year, and it sort of flattened out. So you almost got that yield curve inversion, but not quite. It was actually just flat. And then by 1992, the recession was all cleared up. We were into the booming 90s, and the yield curve returned back to the normal upward sloping. All right, so the 90s were good, and then we had the early 2000s recession and 9/11 happening and all of that. And the dot-com stocks were kind of blowing up there, and you could see here that 3-month yield curve, it went right up straight past the 10-year yield. And then the stock market had a very long-lasting decline that went on for about 2 years, where it kept going down and down. And during this time, the Fed started cutting rates, and they cut and cut and cut, and the interest rates went all the way down to 1% on the short-term end of the yield curve, but the 10-year kind of stabilized. But the 10-year kind of stayed up there around 4%. So you went back to the upward sloping as the recession was starting to clear up. So are you seeing the pattern here? Fed raises interest rates. That pushes the front end of the yield curve up. And then it goes up above the longer term yields. And then the economy goes into recession, and the Fed starts cutting. So, you could probably say that the yield curve is an indicator of an impending recession, but a lot of that might be a factor of the Fed's actions and the stability of the longer-term interest rates. In other words, the longer-term interest rate, it doesn't move as much, but the Fed, maybe they're changing the interest rates too fast and overcompensating, and that's what pushes the short-term end of the yield curve up. Let's add 2008 to our chart. And as you could see there, we had yet another inversion because they wanted to get rid of those ultra low interest rates. And Greenspan was the Federal Reserve chief, and under his administration, they pushed the short-term interest rates really high, really fast, just as they did in some of those previous ones we looked at, pushed it above the 10-year yield curve. And then the economy slowed down, and then you got this big recession and a stock market crash. So where does that leave us now? Well, we've gone on for quite a period without any sort of a recession. The stock market has been going up steadily, and it was only in 2015 that they began the process of raising interest rates. And as you can see here, just like past cycles, they've been raising them, and they pushed it above the 10-year curve. Let's take a look at the interest rates in 2015. In 2018, they were raising rates, so they pushed up the short-term end of the yield curve. And the longer-term maturities, they moved, but not quite as much. And now this is approximately where we are. The yield curve, it's at best you could call it flat, but there's a little bit of an inversion going on there. So will the cycle happen, the usual cycle of a recession? There's probably a pretty good chance. We've had a long run in the stock market and the economy without a recession. And the Federal Reserve, they raised the interest rates. So with history being our guide, it may play out just like these past instances. Here's a more complete look at my chart. As you can see here, there was another brief inversion that occurred in 1998. It only lasted for 25 days, so that didn't turn out to be anything. But right now we're 121 days. Well, actually, I made this chart a few days ago. We're more like 125 days now into a yield curve inversion. And typically they last about 500 days or longer than that. There are exceptions, but more often than not, they're a pretty good predictor of an at least 20% decline in stocks and a possible economic contraction. So there you have it, folks. Look at previous recessions and their relation to a yield curve inversion. As you could see, a lot of it has to do with the Fed overcompensating and rising interest rates, shooting it above the 10-year yield, which might be what they're doing right now. There's a lot of pressure for them to lower the interest rates. I think the question right now is whether they'll lower the interest rates in time to prevent a recession. I guess I'll leave it up to you to decide what you want to make of it, but here's all the historical data. So I hope you enjoyed that video. Be sure to like my channel and subscribe if you want to see more of this content, and I'll see you next time.